The silver collapse story hasn't ended. It's escalated. On February 3rd, The Hidden Economy released a new video titled Silver Shock. The narrative has shifted. The conclusions have become more extreme. But one question remains unchanged. Are these stories revealing actual structure, or are they simply theater? The video claims that while paper silver on COMEX was trading at $78, physical silver on the Shanghai Gold Exchange hit $101 on February 2nd, a 29% premium. This gap is presented as evidence that Chinese buyers are scrambling for physical metal, while Western futures prices represent manipulated paper prices. Shanghai supposedly reflects real demand. New York and London show false pricing. If China operated as a truly free market, this argument might have merit, but it doesn't. China has capital controls. If silver could flow freely, no valves, no regulatory barriers, arbitrage would erase the gap. Traders would buy where it's cheap and sell where it's expensive. Prices don't stay split when markets are open. But that's not reality. China's market has import-export quotas, settlement rules, and approval friction. Money and metal don't flow in and out at will. When arbitrage channels are blocked, two prices can diverge indefinitely. This isn't conspiracy, it's friction. Two cities cut off by a closed bridge will price the same goods differently. Price divergence happens when movement is blocked, not because one market is more real. He claims Shanghai shows the real price. But Shanghai isn't a free retail bullion market. It expresses a contract price inside a controlled exchange structure. That $101 price was actually the exchange-enforced limit-down price for that day. Shanghai exchange contracts have daily price limits. When markets trigger extreme volatility, the exchange enforces price floors. Prices cannot fall below this threshold. It's similar to Western limit-down rules and circuit breakers. A frozen market cannot be treated as the world's most authentic price signal. Now look at the second capital flow pathway he suggests. In his narrative, Chinese capital goes long in global futures, takes profit, then reverses to sell, triggering a cascade of liquidations that crashes the price. Simultaneously, this same capital quickly flows back to China in 72 hours to buy physical silver at Shanghai premiums for strategic reserves. But offshore dollars don't teleport. They must pass through approval processes, exchange settlement systems, and clearing channels. State capital might accelerate this, but private capital cannot complete instant repatriation. More importantly, if capital were truly free, it wouldn't buy silver in Shanghai at $101. It would buy in London at $78 and ship it back for reserves or arbitrage. That's the rational path. In fact, cross-border arbitrage in China isn't a free path. It's permissioned and institutionally gated. The persistent Shanghai premium proves the arbitrage pipeline is locked. When arbitrage cannot erase price differences, spreads persist. When trading can be institutionally forced to halt, prices no longer reflect pure price discovery. They're outcomes shaped by rules. The video states JP Morgan moved its gold trading desk to Singapore, then weaves this into a broader narrative. Wall Street elites know de-dollarization is irreversible and are orchestrating massive asset migration aligned with geopolitical realignment. The video doesn't explicitly say they're moving physical silver to China, but the implication is clear. Positioned near 29% premiums and central bank hoarding, closer to where the physical silver is accumulating. But moving a trading desk and transferring physical assets are fundamentally different operations. A trading desk processes transactions and client flow. It doesn't warehouse bullion. Even if we assume JP Morgan could move physical silver into China with no regulatory friction, the logic still unravels immediately. What's JP Morgan's actual goal? Arbitrage or reserves? If it's arbitrage and they sell silver in Shanghai at $101, what do they receive? Dollars or RMB? If dollars and de-dollarization is irreversible, as the narrative claims, why exchange precious metal for a collapsing currency? If RMB, cross-border RMB settlement isn't a free channel, it's regulated, quota-limited, and policy-permitted. If profits can't freely exit, arbitrage isn't arbitrage. It's capital freezing. Are they waiting for dollar collapse and U.S. recognition of RMB? Now look at the reserve logic. If the goal is strategic storage, The rational path is simpler, stored directly at Asian logistics hubs. But Asia's main free warehousing and re-export hubs for silver aren't in mainland China. China is a consumption market, not a major international redistribution node. Institutions wouldn't choose the most difficult path to achieve the simplest goal. When a theory requires capital to cross regulatory, currency, clearing, and logistical barriers simultaneously, that's not projection. That's narrative magic. The narrative introduces an even bigger backdrop. Days after silver's crash, the U.S. government held a ministerial meeting on critical minerals. He treats this timing as a signal. In his narrative structure, Shanghai premiums and institutional migration are framed as evidence that America is losing pricing power. To reinforce this, he suggests the meeting discussed how America should respond to losing pricing control. But reality is different. This was a routine meeting about energy transition supply chains, part of an ongoing supply chain security framework from recent years. Critical minerals cover dozens of materials: battery minerals, rare earths, semiconductor materials, defense metals. Silver isn't the core issue. Temporal coincidence doesn't equal causation. Packaging a routine policy meeting as systemic collapse isn't structural analysis. It's narrative escalation. When a story needs escalating theater to survive, it usually means there was never real structure underneath to begin with. Thanks for watching. This is the Fiscal Ledger, decoding the systems we still live under. The modern world wasn't born in a moment. It was engineered over centuries by capital, law, and design. From medieval credit to modern markets, Europe and North America wrote the operating code of power, and we're still running on it.